The Rebel Capitalist Show.
How do we get from the Fed doing tapering, potentially even raising rates while they're doing QE? You want to talk about a paradox? That's craziness in and of itself. But then maybe going to QT, how do we get from this environment back down to the zero lower bound and potentially negative rates of the CBDC?
Yeah, well, basically the bond market is telling you very, very loudly, with curve inversions going on already now, and I can elaborate on that yes, they agree and they believe the Federal Reserve will act, because now we are on the right tail. We are in a situation, as you described, that is kryptonite, politically speaking. You're having inflation at 7.5% and a potential risk of de-anchoring inflation expectations on the upside too, and then starting an wage inflation spiral. Right. And there is no policymaker that wants that. Trust me, nobody. So then central banks have to be seen as actively, acting in a pretty strong manner. And so they've been signaling that. And so the bond market is like, okay, if you say so, then I'm gonna believe you, and I'm gonna price you, and even actually I'm gonna chase you to see how committed are you to effectively act. And now I'm looking at my Bloomberg terminal, and there are 7 hikes priced in for 2022. And 2 more, approximately, maybe 1.5 more for 2023. And then the bond market is saying, stop, that is it. Right. So basically the terminal rate, how it's defined in this hiking cycle, is about 1.75 to 2%. So bond market is saying, you know what, you can do 2022 very aggressive. We believe you, you're going to do that. We price you to do that. 2023, you can follow up a bit more, and then you're done. Actually, in 2024, the bond market is now pricing the Fed to cut rates, George. There is a 50% chance that the Federal Reserve in 2024 already has to resort back to cutting rates.
So how are you extracting that data from the yield curve, or are you going to the Eurodollar future curve? I know it inverts at 2024, doesn't it?
Correct. So I'm using OIS curves, they're called. I can make it simple. That's basically a swap that tells you what is the expected Fed funds future path through a certain time.
Right.
So the euro dollars are based on LIBOR, and LIBOR also has some interbank risk, some more liquidity driven stuff. OIS is really pure. It's all about federal funds future path. And this guy here, if I look at the forward expectations, goes up very sharp in 2022, goes up a bit more in 2023, starts to invert already in 2024. So basically, the bond market is telling, okay, sure, you go, you push on the brakes. We understand you. We price you in. We get it. After 2024, you're done already.
And then they're going back down to zero.
So then what's happening is that also the growth impulse is obviously coming to a halt, because in 2020 we went ballistic with all this credit, and then in 2021 we saw this growth. But in 2021 and 2022. Where is the credit? Where is the credit being created? When is the last time that the government pushed stimulus through the economy actively?
Right.
Banks are lending, yes, but it's a fraction of what we saw in terms of credit impulse last year. So the economy is cyclically slowing down a bit in terms of impulse. We're still growing. It's not a recession, but we're slowing down. And the Fed is coming in and it's saying, private sector, I'm going to make the cost of borrowing very, very much more expensive for you guys by raising interest rates, all of a sudden, very quick. And so the private sector will probably say, okay, then I can't borrow anymore because I have to slow down my borrowing activities because it's too expensive now. So this will compound on the slowdown. And the yield curve is telling you exactly that. Whatever curve you look at, in 2024, the Fed is already priced to cut. 5-year versus 30 years, inverted yesterday. 2-year versus 10-year, it's getting there. So the bond market is very loud. Fed, we get you, but you can only do a very short-term hiking cycle. You're going to be very quick. We understand that. But long-term, the structural headwinds that we have because we have excessive unproductive leverage, an aging society, demographics is what it is. The labor force is shrinking. Productivity is stagnant. I'm sorry, but how do you think we can afford to lever up more and more if rates are not zero or lower in real terms?
Yeah, and if we can't lever up, then that's disinflationary.
Exactly.
Or at least from a standpoint of economic growth, because I want to differentiate between consumer prices and economic growth, and not just in the United States, but globally, because so many people, hear that kind of us macro nerds talk about inflation and deflation. And they say, well, what are you talking about with disinflation? The price of my groceries are going up, 50% per year. The price of my rent is going up by 20% per year. I know that building costs down here in Colombia and in the United States are just absolutely skyrocketing. So there's a big difference between the prices that you pay daily for the stuff you buy as the average Joe and Jane, and economic growth in terms of deflation, inflation, and disinflation. So we're just talking about a retraction in economic growth. So a bit of disinflation, that would not surprise me. And then as the Fed raises rates, I think at some point they're going to hit a level where the stock market starts to puke that back up. And I think the Fed realizes that the economy is really dependent upon really asset prices in general.
Yes.
And so they say, okay, well, we need to wave the white flag here. We got to do something. And that's probably what the bond market is telling us. Do you have a similar view for 2022 or 2023, or how do you see it playing out?
No, pretty much. So this is, to me, 2018 on steroids.
Right.
So in 2018, we had basically the same thing. The Federal Reserve was hiking rates, promising to do more. You remember when Powell went out and said, we are far away from neutral rates. So which basically meant we're going to keep on hiking here. We're fine. The economy is fine. We're just going to do it. And so they basically continued to do that. But the last economic, fiscal stimulus was Trump tax cuts in, what was that, mid of 2017, early 2017. So the economy was already, still growing, but coming back to trend growth. It was not a cyclical, very strong growth. And so they kept on hiking into that. And then at some point, the stock market said, I'm sorry, but I can't handle this. The private sector also said, yeah, but you're making borrowing way too expensive for me. And then earnings went down, and then the stock market went down, and then he had to pivot back in 2019. So this time in 2022, it looks to me like 2018 on steroids. The Federal Reserve all of a sudden woke up and said, we need to regain credibility. We need to make sure that inflation expectation don't become the anchor on the upside, right? So because people start to see 5%, 6%, 7% inflation, they might start expecting inflation down the road to be much higher than 2%. Policymakers don't want. Policymakers, they don't want that. They don't want that. And also real wages are going down now for a year and a half, George. I mean, like inflation is growing quicker than nominal wages. So the real purchasing power of Americans is getting hit. And they don't want that to be the case for so long. So they act. And so how they act very strong while fiscal deficits are coming back to become fiscal surpluses again on an impulse basis. Yeah, but they can hike rates and they will hike rates. But there will be, a point that according to the bond market is not far away from here, maybe 1.5% to 2%, after which we are done. So it's all about the.
I just don't. I'm trying to think through politically and, with the central planners, the financially, the monetary policy. And let's just say that we have this 2018 type event, but CPI is at 6%.
Wow.
I'm just, you know what I mean? I don't have to connect those dots for you. It's just Jerome Powell comes out and says, okay, maybe we better take a more dovish stance. And he gets a call from Biden or the administration and saying, are you out of your mind? You cannot take a dovish stance, because if you do, there is no way I'm going to get reelected with CPI, even at 6%, even if it's down from 7.5. So then, what does Powell do? He says, okay, sure, I won't take a dovish stance, but you realize the stock market's going to go down another 20%, and that's going to crush the entire economy, and that's going to ensure that you don't get reelected. How does that play out?
So basically, that's quite a pickle if that happens, and then they will be faced with two decisions. Do you want to destroy upfront wealth in terms of paper capital gains, 401ks and the likes, by continuing raising interest rates above neutral levels to really cool all of this down, basically? But that means taking upfront losses, large losses. And the problem is that those assets have gone up in price by a lot because of leverage.
You're talking about positive real rate. I mean, you're talking about taking Fed funds to 6%.
Yeah, well, but if you do that, then obviously what you're doing is taking all the capital gains that have been spurred by leverage at very cheap real rates and reversing the process and saying, okay, guys, all these upfront gains you had, forget about them. We need to cancel them. They need to go down by 30 or 40%.
Well, that's if we take all of that, I mean, that's S&P 1000, S&P 1500. If you took out all of the gains that have been as a result of this credit creation.
You basically have to take you look at earnings. So, I mean, how you price S&P, you look at earnings and forward earning capacity of these companies, and then you attach a valuation to those earnings. Now, instead of valuing stuff with real rates where they are today, so long-term real rates are like negative 1%, more or less, you say, no, guys, it's going to be real rates plus 3%. So try to make the valuation of the stock market, but discount future cash flows instead of with the real rates of minus 1% with plus 3%. And try to see at which valuations do you land. There will be future earnings, obviously, the world doesn't end, but the valuations at which you will be happy to buy these future cash flows are not the same. If risk-free real interest rates, I mean, the treasury bond or a Fed funds rate yields you 3%, you're not going to be willing to pay 40 times PE to buy a company, obviously.
Yeah, and Alpha, I'm sorry, I cut you off there. So you were saying that there's two directions they can go. Number one, basically crush capital gains for asset holders. And then number two?
Number two is slowly hurting purchasing power. If that is the case and inflation is more sticky, then they might decide not to crash risk assets or assets. So house prices, stock market. House prices, George, so important.
Yeah, right.
They account for 55% of global wealth. 55% of global wealth. Wow. So the house market is paramount important, much more even than the stock market, because it's a levered version of the asset side of the balance sheet of the global investor. It's so important. And so they can decide to hurt that, or they can say, no, we're not going to hurt that. But if inflation is stickier, in your example, let's say it stays at 6%, we're not going to raise rates that much. So we're going to hurt the purchasing power then of Americans. We're going to effectively inflict on them real wages that are likely to stay negative still, real short-term rates that are likely to remain negative. So we're going to basically make them die by 1,000 paper cuts, rather than go in there and say, bam, 40% house price decline, 50% house price decline. That's not a nice choice, I have to say. So that is, I guess, the situation that policymakers really do not want to be caught in, where they have to choose between an evil and a lesser evil.
Yeah, I think unfortunately that's going to be the position they will be in, though. We'll have to stay tuned and see what happens.
I mean, the other thing, like on the macro compass in December, I went back and I said, guys, if I am a policymaker now, all I want to do is a gentle tightening exercise. That's what I hope for, because I know I have to tighten. I know I have to be politically credible. I mean, inflation is at 5, 6, 7%. I need to do something here. But I want to do it in a gentle way. I want to make sure that inflation comes down gently. The risk assets, maybe they reprice a bit, 5%, 10%, but something affordable. We raise a bit interest rates, the private sector cools down a bit, inflation comes down a bit, and then we can restart the engine. That's what they want. Will they be able to achieve it? Well, they're going to give it their best try, but the situation you're depicting, wow, that's a pickle. So for now, let's see.